This module introduces the theory of accrual accounting. Think of it as recording what really happens, even if cash hasn't been paid or received yet. Remember the periodicity assumption from a prior module? We divide the economic life of businesses into artificial time periods for financial reporting purposes. The fiscal year serves as the organizing basis for economic measurement and financial reporting, and the reporting periods can be the year, quarter, month, and even the day. Sometimes we have transactions that cross time periods, and we need to know when to record those events. Because cash can come before or after an event, we don't use cash as the basis for recording revenue and expenses. We use accrual accounting. The example shown here is a customer ordering supplies on December 26th, and they're shipped on December 29th. The customer doesn't receive the merchandise until January 3rd, and cash wasn't even mentioned. So was there a sale? Was it in January or December? Does it matter that money hasn't been received yet? Well, the company shipped the inventory and completed its end of the sales. So yes, a sale was made and it was in December. This is accrual accounting and the revenue recognition principle. Accrual accounting is an objective measurement, an accounting method where revenue or expenses are recorded when a transaction occurs rather than when payment is received or made. The method follows GAAP's recognition and expense principles. The revenue recognition principle states revenues are recognized in the period in which they are earned. The expense recognition principle states expenses are recognized in the period in which they are incurred to earn that revenue. It used to be called the matching principle because you match the expenses to the period in which the revenue is earned. With revenue and expenses being connected to when they are actually earned or expensed and not being tied to the payment of cash, it makes sense that accrual accounting is required by GAAP. So using cash as a basis for accounting recognition is not GAAP. An easy example of this is a sales transaction. Imagine an inventory item ordered on December 26th, shipped on December 29th, and the customer pays shipping, and it's delivered on January 3rd. When does the sale take place? The revenue recognition principle requires that revenue be recognized in the accounting period in which the performance obligation is satisfied. When a company agrees to perform a service or sell a product to a customer, it's created this performance obligation. Service companies recognize, or also means records, revenue when the services are performed. If the customer is paying shipping, the seller has completed its work as soon as the merchandise is shipped. They have nothing left to do and they have earned the sales income. So the sale should be recorded on December 29th. So what about the corresponding sales commission? The same rules apply. The expense recognition principle requires that companies recognize expenses in the period in which they make the efforts, which means consume assets or incur liabilities, in order to generate revenue. The critical issue is determining when the expenses make the contribution to revenue. Expenses need to be matched with the revenue in the period in which the company makes those efforts to generate those revenues. So if the revenue was earned on December 29th, the commission expense was incurred on December 29th. Notice in that entire example, nothing was said of cash. The timing of cash received or paid is irrelevant in accrual basic accounting. With cash basis accounting, revenue is recognized or recorded when cash is received. Expenses are recognized, recorded, only when cash is paid. Cash basis accounting does not satisfy the requirements of generally accepted accounting principles, GAAP, whereas accrual basis accounting does. The reason we mention the periodicity principle is to remember these are artificial time periods, and yet we have to match the revenue and expenses within these time periods. And within the fiscal years, we have quarters and months that need the accrual accounting adjustments as well. The example we used was for an order shipped in December, but not received by January. But it would be the same if the company had a calendar year and the order was shipped on June 28th and arrived on July 3rd. We would make sure the transaction is recorded in the proper quarter and even the proper month. Within the accounting information system, some of the transactions are automatically recorded in the proper time period. But sometimes that doesn't happen and we have to make adjusting entries. These adjusting entries are changes made to accounts at the end of the accounting period to ensure that revenue recognition and expense recognition principles are followed. Adjustments are necessary because the first pulling together of a transaction data may not contain up-to-date and complete data for several reasons. Some of those are the events may not be recorded daily because it's not efficient to do so. Some costs are not recorded during the accounting period because those costs expire with the passage of time rather than as a result of recurring daily transactions. And some items may be unrecorded. Adjustments are required every time a company prepares financial statements. Every adjustment will include one income statement account and one balance sheet account. Actually, they might include more, but they need at least one of each. And often this information isn't received until a few days or weeks after the period ends. But since we're using accrual accounting, we want it to be recorded in the proper period, and therefore we record adjusting entries as of the last day of that period. We categorize adjusting entries into accruals and deferrals. Accruals are when the cash is received or paid after the revenue or expenses has been earned or incurred. Remember, the A in accrual is for cash after the earnings. Deferrals are when the cash is received before the revenue or expenses have been earned or incurred. If you think of the small letter D, the mirror image is a B for before, so the cash is before the earnings. We classify most adjustments as either deferrals or accruals. Each of these classes has two subcategories. Accruals are either accrued revenue or accrued expenses. And these are typically things that you already know about. Accrued revenue is when you earn the revenue but haven't recorded it yet. Typically, it's a timing thing. So imagine a physician who saw patients and earned the revenue, but the invoice hasn't been created, so the revenue and related accounts receivable have not been recorded. So we record accrued revenue by increasing the revenue and increasing the related asset, usually accounts receivable. For example, on December 31st, an auto body shop repairs a dent in a car for $5,000. The customer promises to pay the service fee on January 10th. With all the other year-end activities going on, service revenue has not yet been recorded, and an adjusting entry needs to be made. So on December 31st, which is the date, not necessarily when we make the entry, but it's the date we record the entry, the adjusting entry increases revenue and increases the asset accounts receivable. So accounts receivable is debited and service revenue is credited. Accrued expenses are very similar. Think about the utility bill which you owe for the month, even though you don't receive the bill till the next month. Since you really incurred the liability and owe the money, it makes sense to make that adjusting entry. So the adjusting entry for the accrued expense is to increase the expense and increase the liability, which is typically a payable. Accounts payable, salaries payable, etc. For the accrued expense example, imagine receiving your company's July Wi-Fi bill in August. The bill is for $1,000, and since the expense was incurred in July, it needs to be expensed in July. So the adjusting entry is dated July 31st and increases the expense and increases the liability. So networking expense is debited and accounts payable is credited. Deferrals can be prepaid expenses or unearned revenues. A deferred revenue is an unearned liability. We typically call these accounts unearned revenue, And don't let the word revenue trick you into believing it's a revenue account. It is unearned revenue and a liability until it's earned. For example, there could be unearned service revenue where a lawyer has received a retainer but has not earned any revenue yet. As the lawyer earns the revenue, adjusting entries are made to reduce this liability and increase the revenue. For deferred expenses, you need to think of the original entry that was made when the cash was received. Remember, deferred is when cash comes or is paid before the revenue was earned or expenses incurred. So, when the cash was received, it must have been debited to show the increase in cash. If it was received in advance of revenue to be earned, the original entry must have credited unearned service revenue, the liability. So in this example, a retainer of $5,000 was received, and the original entry must have been a debit to cash and a credit to unearned service revenue. The amount of the original entry doesn't really matter. The point is, it helps to consider the original entry. If you know what was done, you know what to adjust. So imagine at the end of the month you determine that you have completed $1,000 worth of services. The adjusting entry decreases the liability owed to the client and increases the revenue earned. So the debit is to unearned service revenue and the credit is to service revenue. A deferred expense is originally recorded as a prepaid asset, and the adjustment would decrease the asset and record the expense. For example, prepaid insurance is held in the asset account until it is used. Then monthly, the amount of used insurance decreases the prepaid insurance and increases the insurance expense. For deferred examples, it helps to think of the original entry that was made when the cash was received. Remember, deferred is when cash comes or is paid before the revenue was earned or expense incurred. So when the cash was paid, it must have been credited to show the decrease in cash. The debit must have been to a prepaid asset. If the insurance policy is for 6 months and costs $12,000, the original entry must have been a debit to prepaid insurance and a credit to cash. A month later, the adjusting entry is for the month used. If the policy of $12,000 is for 6 months, the amount used is $2,000. The expense must be increased and the related asset must be decreased. So the entry is a debit to insurance expense for $2,000 and a credit to the prepaid insurance for $2,000. This slide shows a summary of each type of deferral or accrual with examples. For accrued revenue that is earned but not yet recorded, the adjusting entry makes the recording to record the service and bill the customer. It also records the interest revenue earned that will be received in the future months, sometime later. Accrued expenses are those that have not been recorded, so the adjusting entry does that. We mentioned utilities, but other accrued expenses are salaries owed employees at the end of the period. Think about employees that are paid by the week. The expense is recorded each week, and the total expense for a company can be a material amount. So when the month ends on a Tuesday, the salary expense for Monday and Tuesday needs to be in the proper time period, and an adjustment is made to do this. Another accrued expense is interest owed on a loan. The amount owed at the end of the month, even though it isn't paid till the next month. And this is why the adjusting entry is the expense and the payable. The deferred revenue mentioned earlier was from a retainer, but other ones can be for subscriptions. If you receive a subscription for the year, you owe the customer your goods for a year. Each month you make an adjusting entry to reduce the amount you owe them, and you record the revenue for the amount you provided and earned. The same thing's true for airlines fees. The airlines receive money for the flights and they owe the customer the flight. But when it occurs, they no longer owe it and the liability is reduced while the revenue is earned. The last example I have is insurance. This example is the insurance company side, where the company owes the insurance and earns the insurance revenue over time. The opposite for the unearned liability called insurance revenue is the deferred expense called insurance expense. Since insurance is owed to the company, it has a receivable, although we call it prepaid insurance. Over time, the amount of insurance to be received decreases, and so adjusting entries reduce the asset's prepaid insurance and increase the insurance expense. Supplies are also an asset when purchased. Over time, supplies are used up. Adjusting entries record the decrease in supplies and an increase in supplies expense. And another deferred expense is depreciation. The purchase of the asset has been recorded, and over time, the asset has wear and tear and is being used up. Similar to supplies expense, the asset decreases and the expense increases. Here is a quick comment on depreciation. We talked about recording assets at the cost paid to get them ready for their intentional use. This was the historical cost principle. Well, there's another principle called the Conservatism Principle, which state you report things at the conservative value and record probable losses or expenses while not recording gains until they are recognized. This keeps companies from overvaluing their financial statements. So how do we keep equipment and other assets that wear out on the balance sheet at the price we paid for them while still showing they're decreasing in value due to the wear and tear of those assets? Well, first, we know the value of those assets decreases due to wear and tear and call this expense depreciation expense. However, we also recognize the value of the assets need to decrease. So how do we decrease the assets and still keep the historical cost principle? We create a contra asset called accumulated depreciation. A contra asset is an asset that reduces the value of its matched regular asset. Adjusting entries increase depreciation expense and increase the contra asset accumulated depreciation. The depreciation adjusting entry is a standard. It's a debit to depreciation expense and a credit to the contra asset accumulated depreciation. Since a contra asset reduces the value of its related asset, together we have a net book value as shown here for the net book value of the building. We have the asset recorded as its original value and keeps with the historical cost. And by matching it to its related accumulated depreciation account, we can show the net value of the asset decreases and keep with the conservatism principle. Back to the examples. For now, just know to call the expense depreciation expense. And instead of reducing the asset directly, we reduce it by decreasing the net total value of the asset. Here is a summary of the adjustment categories, how the accounts are incorrect before the adjustments, and how the adjusting entries adjust the accounts to make things correct. For example, accrued revenues are the revenues that were earned and not yet billed. At this point, the company should be receiving payment, so the assets are understated. And they should have more revenue, but they haven't recorded them yet, so revenues are understated. The adjusting entry fixes that. You can go back to all my prior examples and see that the before adjustment and adjustment values hold. In prior videos, we prepared the financial statements from the balances that existed after the transactions were all recorded. The same is true now, and the financial statements are prepared from the balances after the adjusting entries. I'm a fan of ways to remember things, and since the accounting cycle is a repeating set of steps, it helps to have a mnemonic. The mnemonic for the accounting cycle and the sentence I like is tasteless, jolly telemarketers accept boring fashion. Using the first letter of each word, we have the cycle. The transaction occurs. Entries are journalized. The entries go in the general journal and they're posted to the general ledger. The balance of each of the general ledger accounts is used to prepare the trial balance. The purpose of the trial balance is to show that all debits equal credits and help make proper adjusting entries. Next, we make those adjusting entries in the journal and post them to the ledger. From there, we prepare an adjusted trial balance and double check that the balances are correct. And finally, we prepare the financial statements. That's a summary of accrual accounting. Remember, accrued expenses are when the cash comes after the revenue is earned and expense incurred. And deferred revenue is when the cash is received before the revenue is earned or expense incurred. Each has their own type of adjusting entry that must be made. We also introduce the contra asset, which offsets an asset and allows, for this example, depreciation to follow, and it allows the Conservatism Principle to be followed. I hope this helps. Please let me know if you have any questions.